Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and it is Friday. Today is actually Friday, February 28th. We're recording today for Investment Friday, and Brad Haines, Chief Investment Officer of Juncture Wealth Strategies, is back from cruising around in the ocean. You're here.
Yeah.
And you sound mostly healthy. How are you doing?
I'm doing mostly healthy. I will tell you that the room is spinning still a little bit. There's always an adjustment period when you're on a boat for that long that when you get off, your body has to realize it's on land again. And
Right.
land doesn't move quite like a boat does. So,
Yeah, I told this story when you were gone, but I'm not a cruise person. So I'm always amazed when people, and that's like the go-to vacation is the cruise. Like, I can't do it. I don't like the cruise.
it's interesting. I'm okay with cruising. Mostly, I really, really enjoy spending time with family who they like cruising. And also, it gives me opportunities to go scuba diving in various locations.
Mm.
What is a benefit of cruising is, I dove in Roatan, Honduras, and then I also dove off of Cozumel, both of
Oh.
which have fantastic diving. And so those were really, really great opportunities. So I do like the fact that I get to dive in two locations at one time. But I will say we also go on, or we're planning to go on vacations where we go to dive resorts that are in nice locations where we just stay in one spot for a while. So
Very cool. Well, that's cool to learn that little bit about you. I've never been diving. The cruise we went on in Hawaii went around the different islands, a few of the different islands, and did have a snorkeling and diving excursion off of one of them. We just did a little bit of snorkeling around there, and that was good. That was good enough.
well, in Hawaii, in certain parts, like Hanama Bay off of Oahu, if you if you're snorkeling, that's as good as you can get. I mean, you put your face in, it's like you just put your face into a fishbowl with all these tropical fish. It's that amazing. So for any of the viewers or listeners, if you have never snorkeled in Hanama Bay, Oahu, in Hawaii, even if you don't like the water that much, I would suggest, because you do not have to go very deep, very far out before you see a massive amount of really colorful and beautiful sea life.
Oh, cool. Cool. Well, there we go. There's a little positive to kick us off what otherwise is maybe it's been
Not
a rough week. It's been a rough
it,
week in the markets. Rough couple weeks.
it has been a couple of rough weeks, particularly starting last Friday, right,
Hmm.
where we had the pretty decent sell off. The volatility has continued for the past 5 days, uh, culminating, or at least partially culminating, in yesterday, where we sold off pretty good. And we've had a trend a little bit that I've noticed, and this is very, very typical of an uncertain period in the equity markets, is where in the morning they trade up pretty nicely, and then as the trading day progresses, it starts to trail off, and then by the end of the day, you're in the negative territory. Um, and there's a lot of reasons for that, of why trades are placed at certain points in time. But it also tells you that I think people are not as willing to step in and to support those prices because of the uncertain nature of what's going on economically, from the federal government standpoint, and then also from their own household balance sheet.
Yeah, that's where we're gonna dive in a little bit today. I wanted to talk just a little bit about interest rate forecasts, because that ties in a lot too, right, to the different economic policy. We had talked over the last year, right, the projection last year was that we would continue to get consistent cuts over 2025, and be down, maybe in that 5% range, maybe a little lower through this year. And at this point, we are not expecting very much on that front either, right? Which again ties into the rest of this conversation.
Yeah, I mean, if you look at January of 2024, we expected the markets, I shouldn't say we, the markets in general expected 6 interest rate cuts over 2024, and it turned out to be very different than that. This year, as we started out, people were expecting 3 to 4%, 3 to 4 interest rate cuts, getting down to a terminal rate of around 3%. So the Fed funds, which is currently 4.25 to 4.5%, that would be reduced all the way to 3% over the year. Okay. It's still the markets are still suggesting 2 to 3 interest rate cuts now, with over the course of the next 12 months between here and December of 2025. My personal opinion is I don't think we're going to get that, particularly with Trump applying the 25% tariffs to Mexico and Canada starting Tuesday, and then tacking on an additional 10%. Just to remind our listeners and viewers, he had another 10% tariff applied in February to China's goods. This is an additional 10%. Again, and this is on top of the tariffs that he applied in his first term. So again, as a change, it is going to become, goods are going to become more expensive. Now, the Peterson Institute of International Economics has attempted to estimate what that would do to inflation. Okay. What would the impact of inflation? And again, it's a forecast, it's an analysis. They do the best job they can. Is it going to be 100% accurate? Probably not, but it gives us a good figure to kind of estimate. And they estimate it will increase inflation 0.5 to 0.75% in 2025. Okay. Well, over the next 12 months. So, as we sit here, PCE came out today and it matched. It was 2.6% over the last 12 months. That's really good. And it's actually a pretty low rate. It's the lowest rate it's been in a while. Still higher than their 2% target for the Fed, right? So it's still higher than its target. And now if you add on what the tariffs may come out with, that's 0.5 to 0.75% higher. You're back in that 3.5, 3.75% range. And my thought is that there's a lot of households, consumers that are still reeling from 2021's inflation peak. And they're still living in a mindset of 2021 where it was so high. And to be fair to those individuals and those households, if you go to the grocery store, not much has changed, right? Actually, eggs have gotten more expensive, and eggs have become a very big example of inflation, right? They've used it since 2021 as an example of inflation. Well, there's lots of reasons why eggs are more expensive now, and they should decrease in price over the next 12 months. But it's just been one of the popular examples. So my supposition or my thought is that if we have client or investors with PTSD a little bit, households with PTSD in terms of inflation, and now we see a 1-year inflation spike up a little bit, how does that impact their spending? And my guess is it's going to slow it. The initial evidence of that is in January of this year, consumer spending actually declined for the first time in a long time, 0.2%. So we had a very good holiday season. It may be just households saying, hey, we need to, um, we spent a lot for holidays. Now we need to shore up our savings. And in fact, personal savings did go up to about 4.6%, which is a good thing. But I think a lot of households, businesses are delaying their spending and investing activities a little bit to see what needs to happen with tariff policy, the tax policy. Are we going to get those cuts or are we not? And kind of the complexion of all of those different policies being enacted.
So I misspoke a little bit when I was referring to 5%. What I realized was, oh, that's what we're talking about mortgage rates there, not
Yes.
overall interest rates. Which in the real estate side, uh, lenders are not expecting to get down to 5% this year either. That had been kind of the forecast previously with the Fed rates coming down, but now it's like, no, we're probably going to be staying in that 6 to 7% range this year.
Yeah. Yeah, I would say if clients or if households or people who are looking to buy houses, if they are looking to buy a house, and they're very concerned about the mortgage rate, um, the house builders, so buying a new house, sometimes those builders will offer an incentive to buy down the rate of your mortgage and finance it. Uh,
Hmm.
so that is one way that I think the builders have been able to kind of work around the higher rates, whereas sales of existing homes, the reason they're falling off pretty significantly is because you have to buy down the rate if it's just you buying the existing home. And so that's kind of an impediment for existing homes versus new homes.
Yeah, and it's really interesting because like I've shared on the podcast a few times, like my family, we're moving, buying a new house, and our current rate is like 2.75 on our mortgage now. So it's very low. So we are trading out of a very low interest rate. But this is just not where we're meant to be and stay. So looking at lots of homes, there are many listings now that I'm noticing where there's like the seller who has been trying to sell their home for 6 months, 8 months, sometimes a year at kind of an inflated price. They're starting to drop the home prices and have a little thing on there that says like the seller is willing to buy down the rate for the buyer.
Yep.
And I've never seen that before. So that's super interesting.
Yeah, and that's actually part of a normal market. Okay. I mean, so I think the United States consumer and household got really spoiled by the fact that we had very, very low interest rates for a long time. And what I would say is that's indicative. If you have very, very low mortgage rates or interest rates in the economy, it tells you something in the economy is broken. It's not healthy. Okay. It's healthy to have higher rates or normal rates, I should say, typical rates. And and uh and that's more indicative of a healthy economy where savers and investors and borrowers and lenders are all getting compensated for their activities, whereas when interest rates are super low, it means that someone has to support the economic activity pretty drastically. And that's
Mhm.
what happened for us for the last 15 years was, we were coming out of the Great Recession where, you know, we could have gone into a really great depression. And fortunately, between the fiscal stimulus from the pandemic or the fiscal stimulus from all of the things that the federal government did and also the monetary support, we didn't. We avoided going into a Great Depression and it became what we call the Great Recession, right? And we came out of it fairly slowly. There's some things that I have some opinions about why we came out of it very slowly. But again, it's a way. It's something that when you have a little bit of higher rates, so 6-7% mortgage rates, really prior to the last 15 years was kind of an average. That's not bad.
Yeah, one of my good friends is a realtor, and that's what she's been in real estate for quite a while, and that's exactly what she's saying. She's like, this is actually normal.
Yeah.
And what we experienced for the last 10 to 15 years is the not normal
Yeah.
over longer periods of time. So the 6-7% rate is, again, yeah, like that's pretty typical over over time. But like for me, example, again, 40 years old, millennial, bought my first house in 2007. Um, the rates were a little bit higher than, closer to 5% then, I
Yeah.
think,
Probably.
before things like dropped, right? Because the Great Recession happened right after that. But in like all of my home buyings, I've bought three, my husband and I have bought three homes over the last, whatever that is now, almost 20 years. Our only experience is in this lower interest rate environment. So it is easy to see how, like, oh, no, this is what we're used to. We've bought three homes, right? Like we're used to these lower rates, but
Yeah, it's
it's
the
what it is.
reason, that it's because that's your experience.
Right.
It's a little shocking.
Mm-hmm.
When you go to purchase a new home and it's like, well, here's your 7% mortgage, and you're like, fantastic. That's a little bit odd for you, in your experience.
Yeah.
Um, but it's actually a healthy rate. And it is typical because as the rate is high, what happens? Buyers back away, right? And that's what's been happening in the real residential real estate market. They've been backing away from existing homes, and they've been buying new homes over the past year or two.
Mm.
And those new homes, the reason why they've been buying is because the builders can kind of fiddle with their between their financing arm and their building arm. They can kind of work it out where they can get a decent profit out of that. But how they get that profit could be some in the home, some in the financing. Maybe with certain clients, it's more in the home price as opposed to and very little in the financing, or vice versa. So they've got different levers to play with to get their profitability, but still incent consumers to buy their homes. Whereas existing homes have fallen off because there's very little to do. But the fact that you're seeing incentives being offered by sellers is fantastic. That's really, really good news.
Yeah, yeah, it's interesting. It does feel like the tide is turning a little bit from seller's market to buyer's market. So we should have a real estate person on here and talk about it more
That would be
specifically.
fantastic.
Right? I need to do that. I have a few people I could invite to have those conversations. It would be super interesting. But so that's on the personal side, right? Residential real estate and mortgage prices and whatnot. Uh, when you were talking about tariffs, there's also just so much else going on. And we've talked about this for a couple of months now, since November, results of the election here in the US, that we are going to have a lot of uncertainty. And I think what we've seen, especially over this last month, right? It's been a month and 8 days basically, since Donald Trump took office. We've seen a lot of like a flurry of activity, lots of executive orders, lots of action trying to be taken, and then a lot of action having to be uh, reeled back in, right? With a lot of different legal cases, court cases, um, challenges to, we can't write policy with executive orders. That's not how our government works. So this like action taking and then reeling it back in, and then action taking and reeling it back in has happened over and over again. And one that I'm really concerned about just overall in general, but also on the economy side, is the amount of federal workers that are being fired right now. And so again, some of them have been fired, have left, right, taken the packages that were offered, but then many are were then going back and like, nope, we fired the wrong people. We need to rehire them, right? So there's this so much like
Yeah.
chaos. What is that actually going to do to our unemployment figures when we have such a bit like? 100,000 or 200,000 people losing their job all in the span of a few weeks, potentially.
Yeah, so that's a good question, and I think part of the uncertainty in the equity markets is coming from, um, obviously the Department of Government Efficiency, the Doge. I don't even know if anybody calls it anything else other than the
I
Doge.
don't think so.
Um, but they have the mandate to cut costs and increase efficiencies, right? The problem is very, very few of the top leaders in that department have governmental experience. And so they seemingly are going after the low-hanging fruit. Okay, the things, because the federal government it's the largest bureaucracy on earth. The number of employees, okay, it just is, and it's very expensive to run. Okay, so I'm all for him, or for the Trump administration, eking out savings and increasing efficiencies and increasing effectiveness. Um, Unfortunately, I think what's happening is it's happening in such a haphazard way that people are getting the indication that there is no plan. They are just cutting to cut. And if you cut to cut, then your efficiency can go up, but your effectiveness goes down. So some of the really important people, for example, I'm going to use an easy one, the FAA. Okay.
Hmm.
Federal Aviation Administration is in charge of all of the planes in the air over the entire country, right? As a person who flies a lot, that's a very concerning thing for me. Okay. Because one, they're already understaffed. So if you're going to fire a bunch of people too, how are you going to get this to actually work? Right.
Right.
Now,
Safely.
safely, right? And we've already seen an uptick of a lot of aviation accidents. I mean, there's been the few that I saw a statistic that like 89 aviation incidents have happened uh, this year, relative to last year was 47 for the entire year.
Woof.
Yeah. So we're all of, 2 months into this, and we've already doubled the amount of the entire year. So again, that's not a great trend. And for a flyer who uses it as business and for personal travel, it is very concerning. And I know it is becoming concerning for a lot of other individuals that I talk to that also use a lot of aviation. So it it seems to be it seems to be looking out as haphazard, because then they go back and they hire, oh, these people were actually critical, so then we got to rehire these people. Okay, but we should have a plan before we do that. And
Right.
that is, it seemingly uh they're just going about it with no plan. That's what it looks like. I have to believe there is some kind of plan behind the scenes that we are not privy to. Um, but at this stage, the communication about it, they say it's very transparent, but I mean, I don't see it. I don't see the transparency. I mean, I've gone on the website, I've looked at some of the things they're claiming and savings don't even add up to what they've actually have on their website. So
Yeah.
I'm waiting for time to tell if they're actually doing a good job. Um, but to your question, how that impacts. So Anna Wong from Bloomberg, she's the chief economist from Bloomberg, does estimate unemployment going up in the second half of this year, partially due to the federal government retrenching. Okay.
Hmm.
Now, my assumption that there are a lot of probably jobs in the federal government that are redundant. Okay. They're just, you have too many people doing things that computers can do pretty
Right.
easily. All
Yeah.
right. I haven't heard any announcements of, hey, we're going to implement a new computer system across this department. Again, I'm assuming those negotiations are going on because, for example, using the FAA as an example, continuing with that, their computer system is archaic. from what I understand. Um, so implementing a new system that is reliable and more accurate and more helpful may be a really great way where we can reduce the number of employees at the FAA and keeping safety at a premium, right?
Well, that before you move on from that, there's a super interesting example from last year, not governmental, but with Southwest in particular. Their computer systems completely went down last year and caused tons of chaos, right? Like every Southwest flight, whatever day that was, actually, one of my clients was supposed to be on a Southwest flight. And so he was like caught up in this, and like everything is down. They can't do anything at all because their computer system is so archaic and it went down and there's no way to fix it at this moment. Why was that a thing? Well, they didn't invest in that for decades. They didn't invest in any upgrades. They didn't, like that, where other airlines have shifted and put money into their systems. Are they great? I don't know. They're still not fabulous, right? For the most part, but they're not so archaic that the entire system can go down from one glitch the way that it did, like it actually did, like that happened
Right.
this past year. And so the reason I'm saying that, and the interesting what's like I'm wondering about as I'm talking about this is, okay, if we have to implement new systems to increase safety, to increase efficiency, to increase effectiveness, that costs money.
Yeah.
That's not a current savings. That's
No,
a
that's a
current
future.
expenditure for
Right.
future savings.
That's why I'm assuming that that is going to happen. And I don't know if the Doge will keep that in their tally. Okay. I just don't know if they will, because the departments will have to be spending those budgets because that's who has the budget, right?
Mhm.
Uh, but do I think there's a lot of savings there they could probably do? Yeah. They could probably invest in some better systems and really increase the streamline a lot of it. Got to believe there's some kind of plan because it seems pretty haphazard to me from the start. But we'll see. I'm delaying judgment until give it some time, and if they're able to do it and still run the government, okay. Um, and but we'll see. But
The
to
one
the
of the things
unemployment,
well
go ahead.
one of the things I heard there needs to be a little bit more of a plan. There are two pieces. One very clear example of what they're doing, they're using AI behind the scenes, right? So they're using AI to find their trigger words, which were diversity, equity, and inclusion, and everything else that goes along that they decided goes along with DEI. And one example of how that was like a hammer, taking a hammer to, or a sledgehammer to something where a scalpel was needed instead, was that a biodiversity conference in Hawaii was fully canceled because of like just last week. So a full conference that had been scheduled about biodiversity, which is something that we know is a biological natural. Like
It has
this is
nothing to do
not
with DEI.
right. This is very different. Um, was just full on canceled. And I heard another example of a um an auditory, hearing conference. They're talking about diversity of how differentiation, right? Instead of the other word could have been differentiation, but the way that it was labeled was diversity of something in the cochlear ear. So the word diversity was in there, and this conference was being protested and and targeted because it had the word diversity in it. So we're again the sledgehammer where we need the
Yeah, I mean,
scalpel.
that's that's part of why I have to delay judgment on that is because I've heard those examples, and not just those examples. There's been a lot of, obviously, with firing people and then realizing we can't run the government without those particular individuals. So we have to
Right.
try to hire them back, right? So it becomes an interesting, um, Musk has a lot of strengths. Musk has never made money by running a company through cutting costs. He grew them through revenue gain.
Hmm.
That's how he did all of his businesses. He's never had a business that he's had to come in and cut costs and still run the business. Um, so it'll be interesting to see because I just don't think he has the skill set for it. Um, I think he's got the money for it, which is why I think he's in the place he is. But that's different. That's a different issue. Now, how how these federal layoffs affect unemployment and how they affect economic growth, which was your question,
Hmm.
um, they are going to increase the unemployment rate in the short term. Okay, like I said, the Bloomberg chief economist Anna Wong has estimated second half this year unemployment rising. Now, not skyrocketing, but just rising. 200,000 employees across the U.S. It's not that much. It's just not that much. Okay. Now, if it starts to become millions of people, that becomes a problem. All right, because that does disrupt economic growth, and economic growth is forecasted to slow this year due to the the delay of watching the Trump administration's policy become enacted. Okay. So
Hmm.
economic growth is slated to slow. It's not slated to go into recession, although that word has started to become bantered around. I think it's still premature um, to indicate that we might have a recession. I think um, they could do it in a way that it doesn't slow the economy too much. Um, particularly if they start coming out and saying, "Hey, we're going to do this," talking about the policy, talking about how they're going to implement it before implementing it. But instead, what happens is they announce an intention, then they announce a policy, then they announce another policy change to it, and then by the time it's actually enacted, it's something a little bit different than that. Um, so we'll see how it all transpires. But again, GD when uncertainty goes up, equities struggle.
Hmm.
Um, Rewriting economic rules that increases uncertainty. So we're going to have a volatile equity market for the first half to three quarters of the year. But once we see a lot of these policies enacted, then we can start to make some more investing and spending decisions. And economic growth will resume its upward trajectory again. Um, but all I can say is we'll see.
Hmm. One of the things you mentioned before we started recording was that you've literally had other investment advisors reaching out to you like, hey, what do we do? This
Yeah.
is like the first, we've seen so much volatility in these first 2 months of the year. What do we do for the rest of the year? Um, so yeah, what are you saying
Yeah.
to that?
Yeah. So what I'm telling people is stick with your long-term plan. Don't panic about any short-term events. And I mean, unless you're a very conservative investor, I would still maintain all of your stock investments. Okay. And why would I say that? Because this is the politics of the day, and politics of the day is not a great way to invest long-term monies. All right. It just isn't. Historically, it makes you um, make decisions which are going to be improper and harmful for your own financial health. All right. Even though we want to, because our emotion tells us, "Holy cow, let's do this." Right.
Right. If it's going to be
That
volatile, let's take it all to cash.
right,
Right.
right. Don't do that because your emotion oftentimes leads you to make poor investing decisions. And investing is one of the only places where emotions will almost always lead you in the wrong way. You should almost be doing opposite of what you feel like you should be doing. And the bigger themes of today's markets, with the convergence of artificial intelligence, robotics, nanotechnology, quantum computing, directed energy, nuclear energy, all of these trends are converging, and they're converging and accelerating. What does that mean? What does that really mean? Why would I stay in stocks because of that? We know they're all cool names, the innovation wave, the innovation trend. But what, at the end of the day, all of those technologies allow companies to do is to produce more with less resources. Okay. Or to grow your company more with the same amount of resources. Either way, your productivity is going up. And as your productivity goes up, two things happen. One, your profits grow. And profit growing, growing of profits is the biggest way that equities go up in value. All right. So, and then not only that, if you've noticed, price to earnings ratios, which is a popular valuation metric, if you will, takes the value of your company divided by your net income. Okay, so it's that range has grown over time. Why has it grown? From the low double digits up to where it is today over time. If you look at the trend, there's fits and starts in it, but over time, the average PE ratio has grown. Why is that? Well, because a company in 2025 can produce far more revenue with far fewer employees than it could in 1970, right? I mean, I think that's really easily seen that we're far more profitable. Why? Because of computers, because of the internet, because of technology and innovation. And so applying that to today with all of these really neat innovations coming together and accelerating, it's going to become a much more productive equity market over the next 10 to 20 years. So people looking at today's political turmoil or uncertainty when it comes from a U.S. federal government standpoint, that's a very, very short-term issue, right? Tariffs, that's a 1 year, 2 year issue. That's it. These trends converging is a 10 to 20 year trend. And that aligns with most people's time horizons in terms of their wealth. I mean, even if you're a retiree and you have excess investments, right? So you're not going to spend all your money by the time you pass away. That money should be invested in equities for growth because it's going to become your heirs, your beneficiaries, your the people that you leave your money to. Their time horizons are much longer than yours. So again, 10 to 20 years, if you can just key into the fact that that is the actual trend, and that's a far more powerful trend than the US government today.
What you were just saying, like the visual that was coming to me was like if we're focused on the volatility that we see right now, that doesn't feel good. Like I understand that and the emotional aspect of, however you feel about the administration or Doge or what's happening, right? Like, which can be super frustrating and people are spiraling about it. If we're so focused on that and investing according to that fear, we're literally putting our blinders on. It's like horse blinders, right? To the rest of the opportunities.
Exactly.
So if it's like, oh, I'm afraid of this piece, so I'm going to put everything in cash until I feel better about this particular piece, you're literally missing out on all of the growth and development that when you've been staring at this one dot on the floor rather than like lifting up and having a more holistic view of, the US and the global economy.
Yeah, it's missing the forest through the trees. right? You're looking at
Hmm.
one tree, and instead there's a beautiful forest around you because you're like, I want this one tree to grow.
Hmm.
If it's not growing or not changing the way you want it, you can't miss the fact that you're in a complete forest. And that
Yeah.
is, and that is what I'm like talking to advisors, talking to clients, talking to other people who are um, interested in that, in the investment markets. It's important for people to understand the more powerful trend. And the more powerful trends are those innovations which are coming to pass, which will revolutionize the way we live, the way we work, the way we receive our medicine, the medicines we receive, the materials we use to build houses and cars and the things we use. Um, all of that is changing. You know, yesterday Amazon CEO gave a great interview to a Bloomberg reporter and was talking about quantum computing. And people that are not interested in technology or may not be familiar with what quantum computing is, but quantum computing is just once we figure that out, it will accelerate everything in AI, robot, everything will be accelerated by that much faster. And so it's a really interesting and a very, very exciting time. So what I would caution or counsel the viewers and listeners today is don't get caught up with that tree. We have a whole beautiful forest that is coming at us, and we really, really don't want to miss out on those trends.
Yeah, that's good. That's a perfect place to wrap it up for today. As always, you know how to reach us if you have questions. Um, if you've noticed anything or if you are seeing, other trends in your industry, maybe we would love to hear about whatever's going on, or whatever questions you have. You can reach us. Everything for your contact information is in the show notes. You can grab stuff there. Brad, I'm glad you're back. I'm glad you're safe. And thank you for being on with me today. Always appreciate
You're
it.
welcome. Thanks.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.